Welcome to the video on the Roth conversion trap, where we examine when converting a traditional IRA to a Roth IRA could be a costly mistake. We'll walk through the simple math, the decision framework, real-world scenarios, and practical steps to make smart choices. We will also include quizzes to test your understanding and a clear disclaimer to keep things responsible. Let's begin. Here's the agenda. First, we'll define a Roth conversion and why it triggers immediate tax. Next, we'll cover the core math, the comparison between your current marginal tax rate and your expected effective tax rate in retirement. Then we'll provide a decision framework with a flowchart, followed by real-life scenarios. After that, we'll explain how to execute bracket-filling conversions. We'll highlight common pitfalls like IRMAA surcharges, Social Security taxation interactions, and capital gains effects. We'll include a couple of quick quizzes, and finally we'll wrap with a summary and action steps. A Roth conversion means moving dollars from a pre-tax account like a traditional IRA to a Roth IRA. That transfer is treated as taxable income in the year of conversion. Although Roth accounts can allow tax-free withdrawals later, paying tax now can be a poor choice if your current marginal tax rate is higher than your expected effective tax rate in retirement. This is particularly relevant for high earners. The central calculation is straightforward. You compare your current marginal tax rate with your expected effective tax rate in retirement. If your current marginal rate is higher, converting now pays more tax than you likely need to. Therefore, conversions generally do not make sense for high earners at their peak income. Conversely, if you enter a year with unusually low income, your marginal rate may drop into much lower brackets. In that case, partial conversions can be beneficial because you pay tax at lower rates today. Always consider interactions such as Medicare IRMAA surcharges, Social Security benefit taxation thresholds, and capital gains stacking, which can raise your effective costs and change the math. This strategy works best in temporary low-income years. Identify a year where your taxable income is unusually low. For example, a sabbatical, a gap year, early retirement years before claiming Social Security or Medicare, or a year with business losses. Estimate your taxable income and determine the room you have in the lower tax brackets. Then, execute a partial conversion to fill those brackets without crossing into a higher bracket. Review collateral effects, Medicare IRMAA surcharges, Affordable Care Act premium credits, state income taxes, capital gains implications, and whether the conversion could cause more of your Social Security benefits to become taxable. Reevaluate annually because your optimal conversion amount changes as your income and tax laws change. Keep documentation of your assumptions and update your forecast as retirement nears. In practice, high W-2 earners in their peak years typically should avoid conversions because their current marginal rate is high. During a career break or sabbatical, partial conversions often make sense. Early retirees may have several years before Social Security and required minimum distributions begin, giving them multiple opportunities to fill lower brackets. If you have significant equity compensation vesting in a given year, adding a conversion on top of that income can be counterproductive. A business loss year, or net operating loss carry forward, can reduce the effective tax on a conversion. State taxes also matter. Some people time conversions for years when they reside in a lower tax or no tax state. Converting now secures Roth characteristics such as tax-free growth and no lifetime required minimum distributions for the original owner. It can also hedge against potential future tax hikes. The cost is the tax you pay today, which may be at a high marginal rate, plus possible triggers like IRMAA or ACA impacts. Deferring conversion allows you to avoid paying at high current rates and preserves the option to convert later when your rate is lower. However, tax rates may rise, your income might be higher than expected, or future RMDs could push you into higher brackets. Estate planning considerations also factor into this decision. This is a simplified, hypothetical bracket example to illustrate the concept of bracket filling. The idea is to use the remaining room in your current lower brackets to convert just enough so that you do not spill into the next, higher bracket. In this example, you convert $10,000 at 12% and $15,000 at 22%. Paying approximately $4,500 in total tax on $25,000 converted. The specific bracket thresholds and rates change over time and differ by filing status and jurisdiction, so always consult current tax tables and a qualified professional. This flowchart presents the decision logic. First, Compare your current marginal tax rate to your expected effective rate in retirement. If your current rate is higher, do not convert. If your current rate is lower or roughly equal, check whether this is a temporarily low-income year. If it is, consider a partial conversion, limiting the amount to the top of your intended bracket to avoid spilling into higher brackets. If it is not a low-income year, it is usually better to maintain your current account structure. In all cases, reevaluate annually and account for IRMAA, Social Security taxation thresholds, and capital gains stacking, which can alter the effective cost of conversion. This timeline shows how your tax situation evolves. During your working years, income and marginal rates are often high. In a sabbatical, gap, or early retirement phase before Social Security and Medicare begin, income is lower, creating the best window for bracket-filling Roth conversions. When Social Security and Medicare start, pay attention to IRMAA and Social Security benefit taxation. At required minimum distribution age, pre-tax balances can generate taxable income that pushes you into higher brackets, which is why earlier, strategic partial conversions may be helpful. This mind map centers on the future effective tax rate. Factors that can raise it include required minimum distributions from pre-tax accounts, the portion of Social Security benefits that becomes taxable, changes in state tax residency or rates, legislative tax increases, strong portfolio growth increasing withdrawals, capital gains stacking with ordinary income, other income sources like pensions or annuities, and filing status changes such as the so-called widow's penalty. All of these should be considered when estimating your future effective rate. Quiz question. What is the most reliable time to consider a Roth conversion? Option A, during peak earning years to lock in future benefits. Option B, in a temporarily low-income year to fill lower tax brackets. Option C, right after a large RSU vest to keep momentum. Option D, every year, no matter your income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Low-income windows allow you to convert at modest rates and preserve the benefits of Roth accounts without overpaying upfront tax. This aligns with the strategy of filling lower tax brackets rather than converting while in a high marginal tax bracket. Quiz question. If your current marginal tax rate is 35% and your estimated effective retirement rate is 18%, what is the prudent move? Option A, convert everything now to avoid future taxes. Option B, avoid converting now and consider future low-income years. Option C, convert half now and half later regardless of brackets. Option D, always convert because Roth is always better. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying at a 35% marginal rate today to avoid an estimated 18% effective rate later is likely overpaying. It is usually better to wait for a low-income year and convert at a lower marginal rate if possible. Here are the key takeaways. Convert only when the tax you pay today is less than or equal to what you expect to pay later. High earners at peak income generally should avoid conversions. Use temporary low-income years to perform partial conversions and fill lower brackets. Watch for ripple effects including IRMAA surcharges, Social Security taxation, capital gain stacking, and state taxes. Reevaluate annually because tax brackets, laws, and personal circumstances change. This cheat sheet summarizes the decision rule, estimation tips, and your annual routine. The rule is not to convert when your current marginal rate exceeds your expected effective rate later. If your current marginal rate is less than or equal to your expected effective later rate, and you have a low-income year, then consider a partial conversion. For estimation, project retirement cash flows and withdrawal sequences, and include RMDs, Social Security, state taxes, and potential surcharges. Each year, forecast income, determine available bracket room, set a conversion cap, check IRMAA and ACA impacts, then execute and document the conversion. To summarize, the Roth conversion trap is paying a high tax today that nullifies the benefits of tax-free withdrawals later. Your best opportunities arise in temporarily low-income years, where you can partially convert and fill lower tax brackets. Always model ripple effects such as IRMAA, Social Security taxation, capital gain stacking, and state tax. Reassess annually because your optimal strategy can change as your situation and tax laws evolve. Disclaimer: this content is for educational purposes only and does not constitute tax, legal, or investment advice. Tax rules change and individual situations vary. You should consult a qualified tax professional or financial advisor before making any decisions about Roth conversions or related strategies. Thank you for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more content. Tell us your conversion plan or questions in the comments.